Hey, welcome back to another weekly review. We've obviously had some action going on this week. You've already sent out a letter that came out, so we wanted to talk about that, talk about what we're seeing in the market and what's going on. So why don't you speak a little bit to the letter you sent out earlier this week and some of the adjustments we're making?
Yeah, so first of all, I think it's important to say that, in my opinion, over the last 25 years, I've never seen such extreme volatility is an interesting word because it usually means downside, but I mean upside in this manner as well. Volatility truly means movement. That's what it really means, but we often refer to it as negativity. But just a few months ago, I mean, it just seems like it was the other day, the market had sold off considerably, 20+% from the high. Many stocks were down 40, 50%. And the negativity, I mean, you could cut with a knife. It was absolutely unbelievable. We went on national television, talked about a rebalance that we were doing, took the opportunity to come to you and say, this is the time that you want to be a buyer when everybody is panicking and when there's actual value and when there's things on sale. And we did that, and I'm very proud of that. Never in my wildest dreams did I think that just a few months later, we would be at all-time highs. Like, nothing ever happened. It's really amazing. I think there's a lot of things in play here, social media, the speed of information, but I also think it's indicative, Logan, of where we are in the cycle. What I mean by that is in the late 90s, markets would have big corrections during the tech run, and I'm talking 20, 25%, many stocks, again, down 30, 40%. And early in that cycle, in the early to mid-90s, people would assume that's it, the market's done, it's over, but then it would recover and it would move on to new highs. And the person would say to themselves, well, that was dumb. I should have bought that dip instead of selling that dip. So the psychology of the crowd evolved. Fast forward to 97, 98, when we would get a dip, people would be salivating. Oh, my goodness, this stock's on sale. I've got to buy. I've got to buy. And they were rewarded. So that's not discipline. That they were not doing it because they did some valuation model and the stock had pulled back to a buy point that they'd been watching. No. So-and-so stock is down. I'm going to buy. And then what they would do is they would load up on leverage or they would borrow the money, etc. And so this became this empowering sort of movement in the market. Market's down, be a buyer. I'll be rewarded. We're off to new highs. It's very similar, in my opinion, to what's happening today. We had this massive correction, a lot of fear, and in my opinion at the time, and our opinion was this is really not it's not real. I mean, the sell-off was real, but these fears aren't real. Like the idea that we're going to have this tariff, 140 or 240% forever, in our opinion, was not real, or there was an opportunity to be a buyer. It was my whole point. Now, again, you're getting people that are looking back and going, oh, I should have just bought. And these dips, again, are being bought indiscriminately. So here we are, fast forward just a few months, brand new highs, stocks, having recovered almost all in certain instances, and there's still some interesting value out there, but for the most part, in big cap technology specifically, it's hard not to look at that sector and go, holy cow, we are once again overvalued. And when we are extremely overvalued, in my opinion, it's an opportunity to take some risk off the table. So that's exactly what we did. It's something we've been wanting to do. We've talked about this over the last year and a half, that leading through 2025 into 2026, our goal was to sort of become a little bit more risk averse in these portfolios. And so we took the opportunity to do that by trimming our last concentrated position in the NASDAQ 100, which is typically tech heavy, in a majority of our managed accounts. And then also booking the final gain in gold. And we're not gold bugs. We're not going to just own gold because it's Monday or because it's 2025 or because it's 2022 or because it's Friday. That's not us. We're going to own gold when it makes sense to own gold. And for the last couple of years, in our opinion, it has made a lot of sense to own gold. Now, it's again, in our opinion, it's becoming this sort of fear trade on currencies and debt and so forth. And in my opinion, it's been a great run. It might continue. Okay, we might leave some money on the table, but I like the opportunity of booking these profits. And finally, and I know this is long in the tooth, but it's just very important. And finally, I think it's important that we took those proceeds, and it is our opinion right now that the middle of the yield curve. So if you think of the yield curve as the very short end is the Fed funds overnight futures or overnight lending rates. They control that.
Yep.
And the long end is the 30-year treasury. So that's like mortgage rates. And so the long end and the short end are very elevated right now. Well, the short end is certainly elevated. The long end is where, in line with the short end. Mm-hmm. And our belief is that through political pressure or the economy or what have you, the short end will be coming down over the next couple of years, right. Probably considerably. That's my opinion. And the middle of this curve will also come down in lockstep.
Yeah, and let me jump in there, because when we're talking about treasury yields, it can be kind of confusing. We're talking about the bonds in your portfolio, but when those yields come down, the bond prices appreciate. It's much like a teeter-totter. So as that interest rate comes down, your bond prices appreciate.
That's right. So in booking some equity gains, we took the opportunity to take some of that money and buy through an ETF. It's incredibly liquid. We could sell it at any time. It's very cost-effective and efficient to do this. We buy the 7 to 10-year Treasury bond market, and the ticker is IEF, Indigo, mm-hmm. Edward, Frank, or Foxtrot, and so we buy this, and quite honestly, right now we feel it's a good place to park the money for a season. I don't know how long that season will be, but it's paying us anywhere from 4 to 5% to sit there. And if yields do go down, it should appreciate. But it's an opportunity, in our opinion, to kind of take a side step out of the equity market and take some gains from gold and see how this plays out. Yeah. That's what we're doing.
No, exactly. And I think the evaluation of what is going on with these massive companies that have dominated the market for the last few years and them rallying right back after April. And again, we're 3 months away from those crazy days that we were having in April. I think it makes a lot of sense. And we're kind of just taking a little bit of a step back, also buying in the IEF, and taking our time as we kind of watch and evaluate what happens with the market. And then when opportunities present themselves, we have the ability to take advantage of those, kind of similar to April.
I would agree with that. And I'll also reiterate, because we talked about this recently, small companies, medium-sized companies, international, emerging. There are still areas that are not at highs, that are very attractive to us. We have continued our positioning in those areas. And so what we're doing is looking at specific areas of the market and saying these areas are overvalued in our opinion, and we want to take those gains and off the table. That's what people are paying us to do. We feel like we're being good fiduciaries in doing that, and then we'll wait and see and evaluate as time goes on.
Now, I know there's a lot of drama going on with the Fed and with different things like that. Is there anything specifically you want to talk about and inform people about that's going on in the news right now?
We're watching it every day, more than we do normally. Yeah. Coming into the summer is typically supposed to be a slow sort of doldrums. A lot of people travel. That doesn't seem to be the case. And so I feel really good about our positioning here. I feel like it is reflective of the uncertainty that even we have, especially in some of the bigger areas in the market. But we're watching the Fed. We're watching the news regarding tariffs and trade, the political discussions surrounding even elections in New York and so forth that seem to be very important that the market's watching very closely. So it's a news-driven market for sure. It seems like it's a very news-driven market. And we're watching that news every day.
Love it. All right. For you out there that are listening to this, if you haven't already, listen to the other video that is in this stream where we're introducing the newest member of our team, Andy Durant, who has been phenomenal with us so far, and you're going to introduce him and do a little interview. So make sure you watch that.
Durant.
Oh, okay.
Andy Durant.
I love it. All right. You guys have a good one.